The 2015 time period really provided an important reset for the market. We've had essentially recession in so many parts of the economy, whether it was the commodity sector, whether it was the industrial sector that also got wrapped up into that. So really, since 2015, since 2016, we've staged this rebound. And I would say we've had the initial recovery. Now we've consolidated. Now we're experiencing true growth. So as I look out longer term, I do think that there's room for this bull market to run. And the corporate fundamentals, which we talk about all the time, certainly support it. But also look at the consumer. That's one area of the economy that I think is adding fuel to the fire. Look at how consumption has driven the 4.1 GDP print last year, or last quarter rather, and look at the personal savings rates, which has now been revised materially higher than it was previously.
I was going to ask you about that because I just read about that this morning with the personal savings rates being up there. Is that because consumers are so flush they can buy and save at the same time, or what's happening?
So it's a bit of a technical revision, actually. The reason why it was revised is because now we're accounting for other sources of income, for example, for business owners, as well as interest and dividend income. We have a better way to account for that now. So that's part of the revision. But I think the message that it sends, it's not only the job growth is strong and the unemployment rate is low and people are quitting because of it, but also consumers are not overspending. So that gives us more comfort in the market, generally speaking. If you look at parts of the market that have been performing exceptionally well this year, of course, it's been e-commerce, but also it's all the things that are tied to e-commerce or consumer spending in general. You could look at the card networks, for example. They've done very well. You could look at warehouses, that are supplying retail. So anything that has to do with the U.S. consumer is actually doing really well.
We've had guest after guest who has come in and told us that this is now a stock picker's market. The time for watching the averages, the major averages continue to climb is over. Yeah. But what you're talking about doesn't necessarily play into that.
But I would actually
you may have sectors that do better. You may have stocks that do better, but
I think there's one sector in particular that is definitely becoming a stock picker sector, and that is the tech sector. I think for the longest time, we were so comfortable with tech earnings and they were continuously revised higher. But as this earnings season has reminded us, the tech earnings revisions are actually starting to peak at the sector level. So we really have to look at specific subsectors. For example, we may like software, how that's positioned in the business cycle, although we do have some concerns about some of the social media companies, given the tech landscape that we're living in.
Mike, what do we watch next? What are you kind of
I've actually watched the very kind of defensive leadership of the market right now. So even though I agree that the fundamentals seem like they stretch out for a few quarters in terms of consumer strength, in terms of earnings trajectory, and all that stuff looks good, the market itself has become more uneven, and it's actually shown a little bit more defensiveness in terms of what is working and what's not. Semiconductors, for example, no longer leading. Industrials no longer really leading. Are they resting and they're going to come back or not? And so that's what I'm looking for in terms of the market trying to signal some kind of a potential slowdown globally down the road.